Hi friends, let us discuss key events for the last quarter. Let me start with Reserve Bank of India monetary policy, in which we saw repo rate cut of say 50 basis point from 6% to 5.5% and CRR of 100 basis point from 4% to 3%. It was much higher than the expectation, but the spoiler to the market was the change in stance by Reserve Bank of India, which changed the stance from accommodative to neutral, which spooked the market and we saw yields going up. In case of GDP and CPI, we saw RBI maintaining its projection as far as GDP for this year is concerned around 6.5, whereas in case of CPI, that is inflation, the estimates were reduced from 4% to 3.7%, which is very positive from a market perspective, and our all other segment of the markets are concerned. Basically, the reason for CPI estimates being reduced over a period of time was expectations of better monsoons as we go ahead and food inflation coming down over a period of time, and which is visible in the recent reading also. Latest reading has been close to 2.8%, which is quite positive and below the RBI threshold of 4%. Which was one of the major reasons why the expectations over the remaining period of the year was reduced. The biggest mover for the market was domestic liquidity. In addition to the liquidity created by Reserve Bank of India over the period, that is starting this financial year till today, we saw close to 2.5 to 3 lakh crores of liquidity infused by the Reserve Bank of India. In addition to that, we saw the impact of CRR coming to around say 2.5 lakh up to say December 25, which probably would support interest rate markets and which has already in fact reduced the rates at the shorter end of the curve by reasonable amount. From an international perspective, we had two events basically. One was the geopolitical event in the Middle East, which impacted the crude oil prices, where we saw crude oil going above 70. Later on, due to ceasefire in the geopolitical situation, we saw crude prices settling down immediately to where it was, which is around $65. On the US rate fronts, we saw stability over a period of time. Probably Fed is waiting for any rate actions till they get clarity on the inflation front, which might arise due to tariff implications and all. And also if there are any immediate impact of your employment or your growth, you might see US going in for an immediate rate cut also. In light of the above, we think Trump tariff threats and spillover over currencies is the existing risk that is driving the market volatile. The impact of uncertainty of US inflation and growth will be a key watch on global front. And on the domestic front, if you look at the evolving growth dynamics have taken the center stage. RBI's forward guidance and the rate cut gives us confidence on the growth supported future policy expectations. In fact, in the recent softening in the domestic inflation paves way for Reserve Bank of India to take a calibrated policy decision. On the liquidity front, irrespective of the tools, liquidity measures are expected to have an impact on the shorter end of the curve. In fact, we have seen the shorter end of the curve moving down reasonably. The recent moves by Reserve Bank of India gives us confidence that liquidity will be managed in spirit of stance. Basically, RBI injected liquidity to the tune of 5 trillion over a period of time in open market operations, and the recent CRR cut would add another 2.5 trillion. Which will aid the transmission of rates into the systemic rates like the lending rates and the deposit rates, and we are seeing this impact coming. From a fixed income perspective, we see a pure value because of reasonable positive real rates zone going forward. And on the inflation front, we feel that 3.7 and GDP forecast of 6.5 indicates a continuity of pro-growth oriented policy mindset. External factors such as dollar or USD or even stable oil prices, basically they will provide the macro stability. In view of all this, we feel that the recent 50 basis point rate cut and the CRR rate cut, which has slightly spooked the market at the longer end of the curve, but the shorter end has come down, provides a basically attractive spread opportunity between these two tenors. Even on the corporate bond, if you look at curve up to 5 year, it's offering a reasonable spread, which is an opportunity for investors going ahead. Thanks a lot and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.